Okay.
Hello, everyone. My name is Jose Hernandez. I'm with United Spinal Association.
I'm Jessica with BCID. Hello.
Before we get started, we're going to go over some of the ground rules.
That sounds
Jessica,
too harsh. Let's just leave it with housekeeping rules. Okay?
housekeeping rules.
Housekeeping rules. So you can see that we're in panelist mode. You can go ahead and leave your questions, like direct questions, in the Q&A. And any other comments or anything, you can put it in the chat box. It just makes it easier. So this way we can get to your questions directly. We have the wonderful Mary here as our ASL interpreter. If you just want to see her, you can go ahead and right click on her to pin her. And today we have the wonderful Miss Brown presenting, but Jose, please pick up anything I left off. I forgot.
If you need closed captioning, we have Otter AI services. The link is in the chat, or you can click on closed captioning and it will be on your screen. So without further ado, please, Deborah, introduce yourself and tell us, what you do, and please explain the relationship that you have with BCID. It's great that you've been doing it so long with them.
Okay. Well, good afternoon, everyone. And thank you for joining us on this informational webinar today. My name is Debra Brown, and I will be your host for the next little under an hour. First, I would like to thank Jessica and New York City Spinal for having me today. I am a volunteer at BCID with a company called CSS, Community Service Society. It's a nonprofit. And what I do there is financial coaching. So that consists of, the financial coaching consists of helping people with their finances, as far as pulling up your credit report, helping you clean up your credit report if you have any issues on there, help you with budgeting and saving money, which, while I'm on the topic, is what I will be discussing next week. This is a 2-part seminar. Next week will be budgeting and saving. This week is all about taxes. And taxes, as you know, can be complicated, but we're gonna do a basic overview. So don't get nervous. It's not gonna be a lot of stuff that you can't understand. I'm gonna explain it to you so that you can understand it. Okay? So I guess all questions you're gonna put in the Q&A, and then at the end, Jessica will run through as many as we can, right? Okay. So we would love for you to join us next week if you can, and I hope you get something from this week and next week. As I said, today we're gonna go through basic tax theory, and then we're gonna apply it in real time so you can actually see how it's going to be applied. Okay, so I may need a little help from the audience. I see there's quite a few of us. I may ask the question, and I'll ask you to raise your hand so that we can, this is gonna be a fun experience. This is not gonna be something, I don't want you to fall asleep halfway through the seminar. So I want to try to make it a little fun. So I might throw a couple of questions or something. And if you can throw your hand up, Jessica, we can see how many hands we have up, correct? Okay. Let's give it a trial run. How many people, when they've gone to get their taxes done, have read the entire form front and back? Throw your hands up. No hands? What, 2 hands? Thank you. Okay. How many people have flipped to the back to see whether they owe or gonna get a refund? And that's all they looked at. Any hands? One hand. Oh, two hands. Okay, so we've knocked out 4 people so far. Okay, so how many people, whoever does your return, you just wait for them to tell you if you're going to get a refund or if you're going to owe. Two more hands, 3 more, 4.
Oh no, it's
Okay.
going viral. Yeah, we got 4 people that was like, no, I just wait for my money to come back.
You just wait for your money to come back. Okay. Suppose you owe money. Do you understand why you owe money? Any hands? 2.
We have 2, 3,
Okay.
3 hands.
Okay. All right. Well, hopefully after this session today, instead of you sitting on the other side of the computer, looking at the back of the computer and not understanding why you're being asked a lot of questions, hopefully you will know what the person that's sitting in front of the computer is looking at, so that you're not left in the dark. Okay. Now, I guess you're probably saying, who am I to give you all of this in front of the computer knowledge? Well, I'm going to tell you a little bit about myself. I worked for the Internal Revenue Service for 18 years. 9 of those years was in the walk-in department or the customer service department, which is the names that they like to use for that department, where people would come and get their taxes done. We would also import tax law to people who did not understand what they were doing. Okay, and I've also taught tax preparation at Queens College and at Brooklyn College. I've had my own business for the past 10 years. I do mainly personal taxes, but I also do some business taxes as well. I've also worked at VITA sites. VITA stands for Volunteer Information Tax Assistance. I've worked at VITA sites, which is a free site for low-income people, for about 30 years. I've had my own VITA site for 10 years. So I'm going to today explain to you some things that I know, some things that I've learned, and some things that I have experienced. And I hope that it helps you to understand taxes a little better. Okay, so if you put up the first slide for me, please, Jay. The first thing you need to do is differentiate. A lot of people don't know the difference between taxes. There's so many different types of taxes. This is just a few. There is sales tax. That's the tax that you pay when you go into the store to buy something, like clothing, housewares, stuff like that. There's payroll tax. That's what an employer pays on behalf of an employee. There's inheritance or estate tax. And that is just what it says, is tax that you pay on things that you inherit or an estate. There's capital gains tax. That's tax that you pay when you have an increase. For example, if you went to the racetrack and your horse won and you won $1,000, that would be a capital gain and you would have to pay tax on that. There's property tax that you pay on your home. There's sales and use tax. That's what a vendor would submit to the state when he collects taxes. There's income tax, which we're going to be talking about today. And there's a whole slew of other taxes. If you've ever heard of consumption tax, progressive tax, valorium tax, there's a whole lot of taxes. But today we're going to talk about income tax, and income tax is the tax that you pay on your taxable income. Not all income is taxable, but most of it is. Your taxable income, that's what we're going to be dealing with today. Thank you, Jay. So what is it that we do with this money, this taxable, the money that you get from paying income tax? What does the federal and the state do with this money? Well, they do a number of things. The federal pay federal salaries, they pay federal retirement, they pay military wages and retirement, they subsidize the states with various things, with their parks, with their transportation. They take care of healthcare. Medicare, Medicaid is one of the largest parts of what the federal government does with their money. They also do research, medical and scientific research, basic infrastructure like roads, bridges, airports, transportation, buses and trains, education, veterans benefits, Social Security, low-income housing. There's a lot, the list goes on and on and on all of the stuff that the federal dollars are used for. The state dollars are used for border education, hospitals, sanitation. Well, I should say New York State. Sanitation, transportation, fire department, police department and public safety, state parks, low-income housing, and that list also goes on and on. Now, while the federal is the same nationwide, the states all have their own agenda as to what they're going to pay for and what they're not going to pay for. So we're going to be talking mainly about New York State. And that's why I have sanitation as one of the things that our state dollars pay for. If anybody has any relatives in the state of Virginia, you'll note that in Virginia, they don't pay for sanitation. They have to have private sanitation, or they have to take their own garbage down to the nearest garbage dump. And the states pay for different things with the money that they collect with the taxes. There are 7 states that don't pay state tax. Everyone has to do federal, but there's 7 states that don't pay state taxes. I didn't know I threw that in there. That wasn't supposed to be in there. The next one is the one with the bullets on it. Thank you, Jay. The one with the bullets on it. While he's getting that one, I just want to tell you that
it's in this same slides.
Yeah, it's the one with the bullets, the 3 bullets on it.
Is it this one?
Yes, thank you.
Okay.
Okay, so the 7 states that do not pay state taxes is Alaska, Florida, Nevada, South Dakota, Texas, Washington State, and Wyoming. So if you live in any one of those states, you'll pay federal tax, but you do not have to do state tax. New Hampshire and Tennessee as well don't have state income tax, but they do require you to pay tax on your investment income. So if you have any income from investments in New Hampshire and Tennessee, you will be doing a state tax for that, but not anything else. Okay, so on this slide, I just wanted to point out the second bullet, which says gross income means all income you receive in the form of money, goods, property, and services that isn't exempt from tax, including any income from sources outside the United States or sale of your home. Okay, so gross tax is all of your money. Now let's take a look at who needs to pay taxes. Okay, on the federal slide.
Are we going back up?
If you're single, this is it, who needs to pay taxes.
But is it the same slide?
No, different slide,
Not here.
not that one. That one. Thank you.
All right.
Okay, this is, like I said, basic, because we can get into a whole lot more, but we're gonna keep this basic, and I'll give you an example. Okay, if you are single and under 65 and your gross income was at least $12,400, you should be filing a tax return. If you're single and you're 65 or older and your gross income was $14,050, you should be filing a tax return. If you're married filing joint and you're both under 65, your gross income has to be $24,800 before you are required to file an income tax return. If one spouse is 65 or older, then the gross income is $26,100. If both spouses are 65 or older, then the gross income is $27,400. Married filing separate, any age, your gross income is $5 or more, you need to file a tax return. For head of household, which means you're single with a dependent, and under 65, your gross income needs to be $8,650. If you are head of household and 65 or older, your gross income needs to be $20,300. If you are a qualifying widower, that means a widower with dependents, under 65, your gross income needs to be $24,800. If you are a qualifying widower 65 or over, your gross income needs to be $26,100. Now, as I said, this is just basic. There are times that's outside of this criteria that you may need to file a tax return. And here is your example. Last year, the government gave two types of pandemic relief. The first one was $1,200. The second one was $600. Anyone who did not receive the $1,200 last year anyone who did not receive the $600 last year and does not meet the filing requirement, if they were single, under 65, and made less than $12,400, if they were under any of these requirements, you would file a return this year to get those credits. You would file a return this year to get those credits. Is everybody with me? Did I lose anybody? If you're with me, raise your hand. Everybody's hands up?
Everybody's raising.
Okay. All right. So with that information, we're going to move along. Now I'm going to give you the formula. This is the one that I messed up, so I may have to pull this one up. This is the federal overview.
Should I stop sharing?
Yes. And I'm going to pull up mines. Okay, so let's go through the basic formula. It's going to be the gross income. We just went through gross income. It's going to be the gross income minus any adjustments to get to your AGI, or adjusted gross income. And then you're going to deduct your standard deduction or itemized deduction to get to your taxable income, because all of your income is not taxable. Only the taxable amount will you look on the computer or in the book and find out how much tax you should have paid on your taxable income. You're going to subtract any non-reimbursable credits, and that will give you your final tax liability. Then you look to see how much tax you paid and add on any reimbursable credits to get your total tax paid. So if your liability is larger than the total tax paid, you will owe. If the total tax paid is larger than your liability, you will get a refund. That sounds like, it sounds like Greek, right? All you have to remember is subtract two things from the income for your taxable income, and then you'll find out if you're getting a refund or if you owe. Now we're going to go into, I'm going to actually show you what I'm talking about, and it's going to sound a lot better. Did I lose anybody yet? Let me see some hands. Did I lose anybody yet? Yeah? No?
Oh, hands going up. Remember, if you have any questions, please put them in the Q&A.
Yes, put them in the Q&A. But I think I'm going to, right now, I'm going to give you guys, I'm going to give you guys an example, and I think you'll find it a little bit better.
So we're looking at the 1040.
Okay. Now, here we go. We're looking at the tax 1040. Now, remember the example that I gave you. Remember the formula that I gave you. Here we go with the formula. So John, on the top here, John is a teacher and he made $40,000. These numbers are not correct. I'm just using them as an example. I want you to understand the theory. So John, who is a teacher, made $40,000. June, his wife, is a manager, and she made $20,000. Together, they made $60,000. So if you look on the tax return, and this, by the way, is a 2017 tax return because 2018 was changed by the president, and it's going to be much harder. It's the same thing, but it's cut up into more sections. So this one is going to be easier to understand. The first section on this income tax is the income section. And you see we have wages, interest, that's on money that you have in the bank. Dividends is the same thing as interest, but it's on stocks and bonds. Taxable refunds of city and state, that's the refund that you got from the state last year, but we're not going to cover that. We're going to keep it very basic. I just want you to understand the things that make up income. Alimony, if you have a business. Capital gains, what we were talking about before, if you have something that you sold and you made a profit on it, like your house or your coin collection, that's a capital gain. IRA distribution, pensions, rental income, royalties, if you're a singer or rapper, farm loss, unemployment, Social Security, and other income would be like gambling, winnings. You could put down there. Okay, so this is everything that makes up income. This would be your gross income. That's $60,000 that they made. Would be your gross income. Now, for your adjustments, the adjustments are always given. You don't have to wonder what they are. Educator expenses, health and savings accounts, certain business expenses of reservationists, performing artists, and fee-based government officials, moving expenses, deductible part of self-employment, if you pay into the SEP or simple IRAs, health insurance, penalty on early withdrawal, alimony paid, IRA deduction, student interest loan, tuition and fees. This is going to change depending on what Congress says. The adjustments will change from year to year. The income will always stay the same. So let's suppose, John, who was the teacher, had $500 worth of out-of-pocket expenses that was not reimbursed to him by the school, stuff that he bought for his classroom for his students. Also, he is paying back his student loan. The interest on the student loan was $500 last year. So together, his adjustments are $1,000. So his income is no longer 60,000, it's 59. That's his AGI, adjusted gross income. That's his gross income that was adjusted. Okay, that's all that means. Now we're going to take a look at page 2. Everybody's with me so far, right? Let me see some hands. Did I lose anybody? Everybody's good.
Hands going up.
Okay, we took the total income, we subtracted the adjusted, whatever the government says that we were allowed to adjust. Okay, now we're going to go to the second page. No, don't close all tabs. Give me a second. We're going to go to the second page. And on the second page, we're going to start off with that AGI, the 59,000. And then we're gonna come in with the standard deduction. If you look all the way on the left-hand side, the standard deduction is a given. They're gonna tell you what it is. So for married filing joint, this year it was $12,700. When you subtract the $12,700, that comes to $46,300. That is the taxable income. Even though they made $60,000, they're only going to be taxed on $46,300. If the tax on that is 10%, that means the tax is $4,360, and they had 10% taken out, which was $6,000. They've overpaid their taxes. So they're going to get a refund of $1,370. Did I lose anybody? Is everybody with me? Let me see the hands that's with me. Okay?
Yep. They're coming
Okay.
in.
Now, we're going to have two different kinds of credits. There's going to be reimbursable credits and non-reimbursable credits. Non-reimbursable credits will lower the amount of tax that you have to pay, but they will not actually put it in your hand. So you couldn't lower, this couple could not lower their taxes by more than $4,630. But they have to have a child where they got child independent care credit, foreign tax credit, education credit if they were going to school, retirement savings if they put money in there, child tax credit, residential energy credit. All of those credits are non-reimbursable, but they will lower the amount of tax that you had to pay. The reimbursable credits, which is earned income credit, the opportunity credit again, the child tax credit, all of these credits, they will actually put in your hand. When you do your taxes this year and 2020, if you did not get those credits from last year, the pandemic credit, the 1,200, the 600, that's where you're gonna see it down here and the reimbursable credit part. So you would do your return like you would normally, well, you don't normally do a return. For people that don't do one, you would put your name, address, social, all of that stuff on the top of the first page. You would skip everything else because you didn't have any taxable income or anything, but you would go straight to this payment section that would give you the reimbursable credit, and you would fill in the part for the pandemic credit, and you would get that refund. You would get that credit at this time. I hope I didn't lose anybody. Okay, so I'm gonna give you another example really quick. Suppose this couple, John and June, suppose June went to school and she got the American Opportunity Credit. She got $1,000 credit. Instead of them having $6,000 in payments, they would have $7,000 in payments. And instead of them getting a refund of $1,370, they would get a refund of $2,370. That would be $7,000 minus the $4,630. Okay. I think I should not have lost anybody yet. Okay. I'm gonna try not to lose you again. This is the other part of the formula. Remember when I told you you can either itemize or use your standard deduction? The standard deduction, which is a given over here on the left side, The standard deduction is the amount the government allows you to make before you have to start paying taxes. That's why you subtract that from your AGI. They're allowing you this amount, a married filing joint, 12,700 before they have to start paying taxes. So if you can itemize from a Schedule A more than that $12,700, you can itemize and raise it higher. Let's give you an example. I think someone had a question about taking off medical. They wanted to take off some medical deductions or something like that.
No, the first, yeah, Jessica.
No, go ahead.
No, good.
Maria's question? Yeah, she says, for those like me who are now working from home because of the pandemic, can we put the internet and phone bills as work expenses? And what about, like, I'm gonna add to that. So what about our like computer working area now in our printer? So how do we add that?
Now that you're working from home, that is gonna take some, that is a very good question too, by the way. That is an excellent question. What you're gonna do there, that's gonna take a little bit of calculation, because you're not gonna be able to take off your entire bill. You can take off what was related to the job. So that's gonna mean you're gonna have to see what the difference is between what you normally use and if your job reimburse you on anything, that's double dipping. So you can't do that. Okay, but there's only certain things you're gonna be able to deduct.
In case of the internet, it's going to be like if you use it from 9 to 5, 8 hours a day, and there's 24 hours in a day, 1/3 of your bill would be basically be able to be deducted. And that's
if it's 1/3. You would look back to what your bill would be before you started using it, and the difference between the two, because maybe you use it more, maybe you use it less, less than a third or more than a third, but whatever the difference is.
What about a person like me? I ain't have a computer in my house. I don't have an interest. Everything I can do off of my phone. But since now working from home, like I purchased my own computer and pieces to put together. Some of them Jose got me, but that counts too.
Are you using it only for business?
Oh, well, 9 to 5 for work.
But you're using some personal time too.
Yeah.
So you have to be able to differentiate the two of them. For example, if I had a truck and I had 1,000 miles on that truck, I bought it new and I put 1,000 miles on it, then how much of that was work and how much of that I would have to keep track of the mileage and stuff so that I could see how much was work and how much was not work. In the case of a computer, it doesn't have like a mileage on there. So you can't really, it's going to be kind of hard to say, I used it this much for work or that much. But what you could probably do is say, this was my regular electric bill before, and now that I'm using it, this is my electric bill. It was $25 a month before, now it's $45 a month. So the other $20 I'm attributing a month to me working. My normal is 25.
Jasenia asked, what about if she bought a workstation because of COVID? Like it was specifically bought because now she works from home.
if she had to buy a workstation, that means she probably has a dedicated area just for home. Is that correct?
Seen it, yes.
Okay, then you're gonna get into more calculation because you have to take the square footage of your home or your apartment and how much of it you're using for work. And then you would also be able to deduct the utilities, that amount. If 1/8 of your space was for in that dedicated space, then 1/8 of your utilities. So you're gonna get into more, calculation. And that's like more advanced taxes. This is gonna be basic. I'm gonna show you one more thing. This is the Schedule A as opposed to the standard deduction. These are the things that's on the Schedule A that you can itemize. It's gonna be medical and dental stuff, taxes you paid, interest you paid, gifts to charity, casualty and theft loss, job expenses, and certain miscellaneous deductions. Now, as I said, this is a 2017. One of the things the president took off in 2018 when he changed this was these expenses here, these job expenses. So you can't put them on Schedule A anymore. You would have to do a Schedule CEZ like you were self-employed to get those deductions. Okay. So, and then down here is the other miscellaneous. So in order to claim your medical and dental expenses, it has to be more than 7.5% of your AGI. So their AGI, remember, was 59,000, John and June. It was 59,000, 7.5% of that, or multiply 59,000 times 0.075, that comes up to $4,425. Suppose they both had dental work, 5,000 each, and it wasn't covered and they had to pay for it. That was $10,000. Anything over the 7.5% is what you can deduct. So if this was the only thing that was on their Schedule A, it's better for them to take the standard deduction than itemize. The only way this is going to be in their best interest is if they have other stuff on this that's going to bring it to more than the 12.7 standard deduction. They may have paid $5,000 into state income tax, state and local. I'm assuming they have a house, so they paid $5,000 in real estate taxes. So that's another $10,000. If they have real estate taxes, they're probably paying a mortgage. The interest on the mortgage is another $7,000. Then they can throw the money on that they paid in church, 10% of their salary. They can throw that on, as well as the $500 that they paid their tax preparer last year, coming to a total of $29,075. Now let's take a look at that second page of that tax return with the 29,000 instead of the 12,700. Now, when you subtract that from their AGI, their taxable income is $29,925. And when you look at the 6,000 that they had come out, now they have a refund of $3,008. But in order to be able to itemize, you have to be able to come up with a number larger than your standard deduction. And as far as medical, that's where your medical stuff would go.
All right.
Okay.
We have about 9 minutes left.
Does anybody have a question? Did I totally confuse you now?
Well, someone said they have a headache.
Yeah. But I'm intimidated by numbers. You might want to stop sharing if you're done. But I get really intimidated. So I mean that could be this other person's reason.
Well,
too.
if you buy a program, it'll do it for you. All you have to do is put in your income and tell it what deductions you want to make, and the program will actually do all of that other stuff for you. But as long as you understand basically what it's doing to make sure that you get all of your proper credits.
I think a lot of us working from home are going to
Looking
experience
for an
some of
hour.
those options this time around, because I know
Okay.
I.
Is there another question?
Yes. Anybody else got any questions, answers, suggestions, solutions? I know that if anybody wants to speak with Ms. Brown, you can go ahead and call.
Yeah.
ECA.
Jay, can you put the last one up for me, please?
Yes, and that's the state one.
The interested in preparing taxes.
Interested in preparing taxes. Let me just put it up.
I hope everybody's learned something. I hope I didn't lose anybody.
Somebody asked a question. Does Earned Income Tax Credit, EITC, affect people with disabilities without children or dependents? Is the interest or loss on able account or pooled trust taxable and or deductible?
Okay. You asked about the Earned Income Credit. Earned Income Credit, if you are single without children, there's a limit. If you're under that limit, you'll get Earned Income Credit. Was that what you were asking? You're on mute, Jessica. Okay.
This wasn't me. He says yes. He says yes.
Yes. You have to be under a certain dollar amount. If you're single, yes, you can still get Earned Income Credit. And everything that I'm telling you, I'm going to tell you where you can find it out. What was the rest of his question?
One sec. I don't know where did I do it. Okay. Is the interest or loss on an able account or pooled trust taxable and or deductible?
Is the interest on
an able account or a pooled trust taxable and or deductible?
Okay.
Jose, I can't speak.
That is actually in the advanced class, so I would have to actually look that up, but I can look it up and get the answer to Jessica, and she can get it to you. Okay, the able account or the pool trust account. I can look that up for you and get that back to you, because that was.
I'm gonna drop our emails in the chat so you can have that.
Okay. Now, the last thing I wanted to tell you, if you're interested at all in learning more about taxes or preparing taxes, there are 2 free programs sponsored by the Internal Revenue Service. One of them is VITA, the Volunteer Information Tax Assistance. The other one is TCE, which is Tax Care for the Elderly. You can go on to www.irs.gov, which is their website. You can go put link and learn in the search box. You have to be over 18 to be a volunteer, and you have to pass the certificate class that's on the link and learn. They show you how to go through taxes step by step. They give you a little test. You pass the test. They also give you a certificate, and you can volunteer at a VITA site or a TCE site and help people prepare their taxes. Also, if you want to go to the New York State website, that's www.tax.ny.gov. I would suggest that you go to both sites. Both of them allow you to create an account with a username and password so that you can have access to your individual information. And it's interesting just to go to those sites and just see what's up there, and just it'll tell you all about the pandemic money, and what the criteria is for that. Is much too much information for any one person to remember, but if you know where to find it, that's all that can be asked of you. I want to thank you so much for joining me today. I hope you have learned something. I want to thank Mary for being such a wonderful interpreter. I want to thank Jay from New York City Spinal, Jessica from BCID for having me. It's been so much fun. And please join us next week so that you can find out about where you should save your money, where you shouldn't spend money, and what kind of budgeting you should be using and how that would help you to save money.
Maybe.
Thank you and have a blessed weekend.
Thank you, Deborah. Maybe next week we can cover, how to fix your credit score. Because I know that some individuals who are institutions,
Mhm.
they have that, they fall into the trap where their credit score gets bad. And when they try to transition from an institution into, finding housing, it plays a big role on what kind of apartment you can get, because the first thing they do is run your credit.
Okay, I will definitely include that for next week. So that will be one of our topics for next week as well. If you want to know how to clean up your credit, we can cover that as well.
All right. Thank you, everyone.
Okay.
Thank you, Ms. Brown. Thank you,
Thank
Jessica.
you.
Thank you, Mary. And I hope to
And
see
thank
everyone in
you,
the next one.
audience. You've been a wonderful audience. Thank you so much.
Let's see those hands go up.
Yes.
Put those hands up.
And
Bye.
see you next week.
Bye-bye.
Bye, guys.